Okay, thank you everyone for joining. Thanks to you who are joining me live, and thanks to you who are watching this recording. This is our presentation of the Southeast Memphis portfolio, 384 units in Memphis, Tennessee. So before we kick things off, let me start off by first reading the legal disclaimer. You can pause here and read through it, but real quick, this is not an offering or a solicitation to purchase a security. This is for informational purposes. All the details will be in the confidential private placement memorandum, which we will send to you if you decide to move forward with us. So all fun and games until then, let's get started. So during this presentation, what we'll be going over is the investment highlights, the team. We'll share a property video. We'll go over the executive summary. We'll highlight a sampling of our track record. We'll give a little insight into the market overview, our business plan as it relates to these properties, the capital stack, our financial projections, and how they will have an impact on the investment returns and structure. And then we'll go over next steps and contact info. So at a high level, this is what we're projecting between these two properties. It's about 11% cash on cash return, about 2.1x equity multiplier in 6 years. It's a strong location in Memphis. It has high occupancy, and we have a very clear value add strategy, which we'll be highlighting here deeper into the presentation. So part of the team is, I'll hand this off to Patrick to introduce himself and Think Multifamily.
Thanks, Tom. My name is Patrick Duffy, and I am with Think Multifamily. We are a regional operator of garden-style multifamily properties in Dallas-Fort Worth, Atlanta, Memphis, and Jacksonville, with approximately 4,000 units under management. My partner is Mark Kenny, and together we originated this transaction in Memphis, where we have pretty strong relationships with the local brokerage community, and we're brought this transaction to trade into with a brokerage team that we have worked with in the past. I have been a full-time multifamily syndicator since approximately July of 2017, and prior to that, held numerous capital markets roles at banks, private equity firms, and hedge funds. And gradually moved into multifamily syndication while working full-time, and then began full-time multifamily syndicating in July. Mark, on the other hand, who is the founder of Think Multifamily, has been investing in multifamily for about 20 years, and just over 20 years beginning in college, and started acquiring locally in his market of Dallas, and started Think Multifamily as an educational platform and syndication partnership platform several years ago, and has since grown his portfolio outside of Dallas to include Atlanta, Memphis, and Florida.
So, sure, I'll introduce myself. So I'm Tom Reed, and I have about 137 units that I participate in, and I've been doing multifamily investing. I started off in about January of 2017, and have known Patrick and Philippe for almost that entire time, and currently working W-2, but working towards full-time real estate investment, and putting the focus on the equity component, the equity raise, and that aspect of the multifamily acquisition. Philippe?
Yeah, thank you, Tom. My name is Philippe Telegan, and I started, 3 years ago, like Tom, in multifamily investments, and that's when I met with Patrick and Mark, actually. And since then, I've accumulated 350 units total. Actually, I think it's a portfolio around $11 million. And otherwise, I work in the air and space industry, and have a master's degree in mechanical engineering. So I'm going to introduce you to Multi-South. They are our preferred partner in Memphis. Actually, Multi-South is managing for us 700 units right now in Memphis, and we've had great success with them. And we a few months ago just moved some of our properties to have them manage them, because we were not too happy with the previous property manager. But otherwise, so they are based in Memphis, and they radiate in all the states around Tennessee. They have, I think, above 7,000 units under management. And the two principals, David Shores and Keith Shepard, whom we met several times and we speak regularly to, have 30 years each of experience in multifamily management. And we've had great success with them. Again, we'll see that later on in our sample of our track record. Tom?
So what I'd like to do now is share with you video, aerial drone footage of each of the properties. So sit back, relax, and enjoy the video. It will be a quick watch. Okay. So now we have the executive summary, and I'll hand this off to Patrick to talk a little bit more about the properties and a bit of the market. And take it away, Patrick.
All right, thanks, Tom. So the portfolio is consisting of Hickory Farms apartments and the crossing at Fox Meadows. Hickory Farm comprises 200 units, and the crossings at Fox Meadows, it comprises 184 units. Hickory was built in 1985, and the crossings was built in 1973. And they have a relatively long history of institutional ownership by a firm based up in Boston with about 25,000 units in their portfolio. And these assets represent the last of their holdings in Memphis that they are selling. Both of the properties are located just less than 3 miles away from close to 2 million square feet of Class A office space, and also just minutes away from I-240, which is Memphis's interstate loop. Both properties have very quick access to retail and office corridors, and just really offer tenants easy way to get to employers. The things that we really love about these assets is how well they've been maintained on the exterior. and the fact that they have 100% classic units. So there's very, very little work that needs to be done on the exterior of these assets, really allowing us to focus primarily on interior improvements. And we've identified approximately $125 and above of rental premium that we can achieve via some very standard interior upgrades that we've had success with at some of our other properties in town. And another option or another avenue of added value in this portfolio that were also very attracted to us was the fact that this owner, being such a large owner and institutional in size, have really ran this property very heavy on operational expenses. And working with our property management partner, Multi-South Management, we've identified approximately $500 or more per unit in annual operating expense savings. And so just looking at where the properties are currently operating from a expense perspective and looking at the other properties that we have in Memphis, we're really seeing some pretty heavy expenditures in areas where we can reduce those expenditures and operate them more in line with market standards, further increasing value and NOI. And so speaking a little bit to our track record in Memphis, and Philippe will join us in here as well, because he's been involved in a couple of these properties. Dogwood Trace is a property that was purchased in April of 2018 for $4.2 million. It's 168 units. At the time of acquisition, it was approximately 91% occupied, and today it's 97% occupied. We've been able to increase revenue by about $75,000. And today, a very conservative estimate of value is 4.6, although we believe that that is a little bit light and probably is a little bit beyond that. And Cooper Young Apartments is an 80-unit property that was purchased just towards the end of 2017 in November for $2.67 million. At the time of purchase, that property was 85%, and today it is 95%. We've been able to increase revenue just over $130,000 at that asset, and the current value estimate is at $3.7 million. And Country View Apartments was our largest acquisition to date in Memphis, and that was in December of 2017. It was 321 units. That property was purchased from the original developer and owner of the asset, and we were able to take that asset from 69% occupancy to 95% occupancy just in a little over 6 months in owning the asset. We increased the revenue from 1.3 million to 1.93 million, and we are in the process of completing a refinance currently on that property, which will enable us to pull out 100% of investor capital just in about 14 months of ownership. And we just received a $15 million appraisal from CBRE in connection with that refinance process. So we've had a tremendous amount of success in Memphis. We really like Memphis quite a bit. Certain markets are more attractive than others in the Memphis submarket, so we're very diligent about where we purchase and the types of assets we purchase. And the Southeast Memphis portfolio of Hickory and the Crossings are representative of that strategy and understanding of Memphis. So, Philippe, did you want to add anything on Dogwood and Cooper?
Yeah, just on Dogwood particularly, because Dogwood was a property that was owned by David Shaw's co-owner of Multi-South previously when we purchased it. And they did a great job renovating that property that was in bad shape. You know, it was like 60% occupancy, and kind of the similar to the Country View experience. And he sold it to us at a fair price, and he told us this is how it's going to continue to increase, and this is the path. And now we are owning it for a little bit over a year, and we are on that path, and we've been very successful on target, and it's a nice, decent, clean property. It's doing its job very well, attracting very high occupancy. They're doing a fantastic job bringing occupancy higher than it was initially, and they really know what they're doing.
Yeah, and just to add to that too, one general statement, and we're very fortunate to have our property manager partner in Memphis in Multi-South, and that none of these successes really could have been achieved without their aiding us during the due diligence process and purchasing process, and then obviously following acquisition, their help in implementing our business plan. And they've been tremendous partners in helping us to increase value and add value to these properties. And so we very much appreciate their work for us and their role in aiding us pre-acquisition and obviously post-acquisition. And that's obviously the benefits that are being brought to this transaction as well. So Tom, we can move on from this slide.
Sure. And before we jump into the market overview, there's one data point I just wanted to highlight in that this is a sample track record that's specific to the Memphis market. And as Patrick had mentioned earlier in the presentation, Mark, who's also part of this opportunity, has over 4,000 units. So it's a much larger portfolio than what we're showing here. This is just really specific to Memphis. And Patrick?
Yep. Yeah, so in terms of Memphis in a general market overview, there's over 1.3 million people in the Memphis MSA. And the really wonderful thing that we like about Memphis and is really largely unknown to many people is how pivotal a role Memphis plays in the national and international economy of logistics. And so from a intermodal logistics standpoint, Memphis has the second largest port on the Mississippi River in the United States. It has the #3 Class 1 railroad in service in the United States. It's the #3 trucking corridor in the United States. And it has the #4 largest inland port in the United States. So it's very, very heavily trafficked, and much of that having to do with its geographical location, which is irreplaceable, given where it stands in the United States geographically and able to touch many states within just short travel, and also due to the fact that FedEx is headquartered in Memphis. So that is also a very potent addition to the market. In terms of news and development efforts that are underway in Memphis or have been in the last several years, spending on new downtown Memphis development projects is projected to surpass over $2.9 billion in the next several years. And based on a most recent data point and story that we viewed, over 250 revitalization projects valued at just over $13 billion, according to Cushman & Wakefield, have been completed in the last 4 years in Memphis. So in our time in Memphis, we've seen a tremendous amount of redevelopment of activity and dollars pour into the city to revitalize some previously historical troubled areas. And so it's really encouraging to see a lot of areas of the city being uplifted and a lot of dollars spent there. And in addition to that, and going back to FedEx, they've pledged to spend $1 billion to modernize their super hub. And St. Jude Research Hospital, which is headquartered in Memphis, just north of downtown, is ongoing a $1 billion expansion of their research campus with an addition of a $412 million research center. So there's quite a bit of activity going on in Memphis, and it's a pretty exciting time to ride that wave and get into the market. And so in terms of the overview of the market in which these assets sit, they're located in the southeast portion of the city, just east of the airport and just south of what is traditionally referred to as East Memphis, where a lot of the Class A office space and higher property values exist within the city. It's very close to retail and office corridors. And Hickory Farm, which you see in the bottom of the screen, it sits on Ridgeway Road, which is a very heavily trafficked corridor, and right across the street from Hickory Ridge Middle School and a community center, which also houses a precinct. So the area surrounding Hickory Ridge is very well maintained, very clean, very safe. And the crossings at Fox Meadows, which you see slightly towards the upper right, is bordered by a golf course and very close to I-240, which was previously mentioned is a major interstate loop around Memphis, allowing people to get to and from employers. And in terms of some of the surrounding demographics of these assets, average household income is just north of $75,000. Average single-family home value is north of $205,000. Just over 57% white-collar employees, and just over 100,000 employees in the immediate area. So very, very compelling submarket of Memphis, and definitely some of the higher end properties that we've purchased in Memphis relative to some of the more working class areas that we've been in Memphis prior. So we're very excited just by the general demographics having a much higher income and job prospect level as compared to some of our other properties. And so now we're going to jump into an overview of each property and kind of talking about the details there and the opportunity and our business plan concerning both. So as previously mentioned, Hickory Farms, it's 200 units built in 1985. All roofs are pitched with an 807 square feet average unit size. There's a favorable mix of 1 and 2 bedroom units and an average rent currently at the subject of $736. The average market rent as identified by the property is $871, and that's what they're actually being able to achieve on new leases without any renovation activity. So there's a significant amount of loss to lease that exists that we're seeking to burn off. Average occupancy, or current occupancy rather, at Hickory Farms is 97%, which definitely adds to the story that rents are under market at that property. Has some really great amenities, fantastic swimming pool, clubhouse, laundry facility, and quite large picnic area where we're planning on putting in a playground facility. And in terms of our renovation package, you can see the typical unit on the bottom right. This is very representative of all the units. They're very classic in terms of their interior, older appliances, vinyl wood flooring on some units, outdated countertops and cabinetry, and very flat paint scheme. So we're planning on putting in new painted cabinets and pulls, black kitchen appliance package, which we've delivered on some of our other assets, vinyl wood plank flooring where needed. We're going to resurface the counters, put in a new paint scheme, and update the fixtures on the interiors. And our average pro forma rent for this asset is $847, which we feel is a very confident and conservative level given where they're actually executing on new leases at the asset. And the crossings at Fox Meadows, a very, very good looking asset. And I like to say that when initially evaluating this asset, I was getting the two kind of mixed up in terms of years of construction, because what's really nice at the crossings is although it's a 1973 construction, the seller has done a tremendous job in terms of putting some exterior finishes in terms of the vinyl siding on the property, which really makes it look pretty fresh and new relative to its age. There's 184 units at the crossings. All roofs are pitched again, which is very good. Larger average unit sizes of just over 1,000 square feet. Very favorable unit mix of 1s, 2s, and 3s with an average current rent of approximately $720 a month. And the property has identified the average market rent is about $764. And we like to say that based on the most recent rent roll that we've received in January, approximately 20% of the new leases are currently over market of about $60 on average. Current occupancy at the crossings is 92%. And this property, again, has very similar amenities to Hickory Farms, has great swimming pool, clubhouse, and mail station, along with some very ample picnic areas where we're going to be putting in a playground as well. The value add strategy is identical to Hickory Farms, where you see on the bottom right, very classic interiors where we're going to seek to put in new black appliances where applicable, new vinyl plank flooring where applicable, resurfacing the counters and painting the cabinets and adding new pulls and an updated fixture package. And our average pro forma rent is $834, which again, we feel is very conservative based on where current leases have been executed and based on the finish out that we plan to deliver. And so diving a little bit more into our business plan, we are going to implement a proven interior renovation package of $4,000 a unit. Tends to average more towards $3,500, but $4,000 at the upper end, within up to 90% of the units in the first 2 years. And we expect to achieve on average monthly rent premiums of $125 or more. And again, speaking to the operational upside, we've spoken with Multi-South and delved into heavily approximately $500 in operational expense savings that we're going to be able to achieve based on market standards operating expenses within the market. And we think that we can go in and implement from day one. And so we are going to go in, increase rents on renovated units, decrease operating expenses, and then following that implementation or sizable implementation of that strategy, we're going to complete a refinance of our acquisition debt and seek to return between 30 and 50% of member capital within the first 2 years. So speaking to the capital stack that we've elected to go with for this acquisition, we are buying both properties as a portfolio. We've received very compelling bridge debt from Bancorp Bank, which we have experience executing transactions with in Memphis. They have a very compelling bridge loan program, which looks and speaks like agency, but it is a bridge. And we are purchasing the assets for $23.2 million with an estimated $2.2 million in renovation costs. You see the closing costs and our working capital expectations there and our acquisition fee to the general partnership with a total cost basis of approximately $26.6 million. Bancorp is lending up to 80% of our purchase price and 100% of our rehabilitation dollars, resulting in a total equity raise for this portfolio of $6 million. And one of the reasons that we elected to go to Bancorp was not only our relationship with them and their ability to execute and their phenomenal terms, but one thing that we took a look at when identifying that, you know, the properties are at 90+% occupancy and definitely qualify for agency, the proceeds that we were able to get with Bancorp were so much more favorable than with agency based on the anticipated upside, both in the rents and operational expense reduction. And so we didn't want to be necessarily limited by the lesser proceeds that we would have achieved on agency day one. So by going with Bancorp, we're able to get some more working capital and capital needed to complete our renovations and then limit our refinance risk following the completion of those value-add activities. And I'm sorry, Tom, can you go back one more? I just want to touch on something.
Sure.
With regard to the debt structure, I should say, so it is a bridge to permanent program. It's non-recourse and has a 3-year term with 2 1-year extensions. So we definitely feel like we have quite a bit of runway with the Bancorp product. We feel that we are modeling currently a refinance by the end of year 3, but we definitely anticipate being able to refinance prior to that. But in some market event where we were unable to refinance by the end of year 3 or year 2, we definitely are comforted by the fact that we have up to 5 years to either sell or refinance the asset. So we're very encouraged by the terms there. We think that that's a major asset in the Bancorp program. Also, it's an interest-only loan with a 5.79% rate. And another compelling item of that is that in connection with this closing, we are buying an interest rate cap, which will allow our rate to stay fixed throughout the entirety of the term. So I just wanted to touch on that. So we can move forward then, Tom.
Thank you, Patrick.
And in terms of financial projections, as mentioned prior, we heavily involve Multi-South in our acquisition process to make sure that our underwriting is succinct and in line with what they are seeing in the market and our understanding of the market in terms of how we'll be able to operate following closing. And so this underwriting takes that into account. And so what you can see is in the first 2 years, we definitely have a large increase in our income in connection with the turnover and renovation of those assets as we bring them onto market rents. And then following year 3, we definitely have a flattening out of our income projections. We really tried to keep our income projection growth levels very flat, not trying to base our underwriting or appreciation off of some unknown market influx or market increase in rents. We really tried to keep them flat and as conservative as possible. And as you can see in year 3, we have a highlighted expense of just over $2 million. And compared to year 2, it's about a $230,000 increase over year 2. The reason that is because in Memphis, property taxes are reassessed on a 4-year cycle. And so they were just reassessed at the end of 2017, and we expect them to be reassessed at the end of 2021. And so our property tax increase in year 3 accounts for that increase in property taxes. So as previously mentioned, we are assuming stabilization and a refinance by the end of year 3, although we do believe we can achieve that sooner based on our experience elsewhere. Very flat income and expense growth assumptions with a favorable economic vacancy assumption all throughout the hold period, and the property tax increase in year 3 as mentioned prior. And so in terms of investor returns and the overall structure, wanted to delve into this a little bit about what this means to the average investor that may be investing in this transaction. What they can expect is an 8% preferred return paid back on the amount of equity that they have in the transaction, paid quarterly throughout the entirety of the hold period. The general partnership will be earning a 1.5% asset management fee, which is in line with market, and a split above the preferred return, 70% of that going to the limited partners or investors in the deal, and 30% going to the general partnership only after the first preferred 8% preferred return is paid to investors. And so what that looks like from a investment perspective, if you were to invest $100,000, you would invest $100,000. Your expected cash-on-cash return for year 1 is 10.2%, followed by 12.5, 11.1, 13.9, 10, and 11, with a refinance event occurring in year 3. So we expect to return approximately 30% of capital in year 3, bringing your total exposure in the deal down to about $68,000. And you will be paid the 8% preferred return based on the capital that you still have in the deal. And then, of course, following a sale of the asset, you will be entitled to not only the return of your initial capital investment or your capital remaining in the transaction, but your 70% split of the profits above that which is owed back to you. And so that all being said, we're estimating an 11% annual cash on cash, a 18% IRR, and which equates to then a just over a 2 times or 2.1 times equity multiple. So really feel like it's a very fantastic return profile on a 6-year hold with the opportunity to return capital during the hold period.
All right, well, thank you, Patrick. So next steps. I'll just be going over a little bit about what the next steps are to participate in this. What you can do is click on the link below, or if you're watching the replay of this, you can just type it in your browser, bit.ly/Memphis2, and that will take you to our investor soft commit page. It doesn't obligate you to anything. It's just a questionnaire to express a level of interest so that we can get a sense of where we are as it relates to our equity raise. Once we receive that, we'll review the information, and then we will be able to provide you with the complete investor packet, which we are expecting to be completed next week. Again, so you understand, for this investment, it's a $75,000 minimum, and we're expecting to have all of the equity wired into escrow by February 22nd, so that we'll have clear visibility into our closing. And with that, that kind of wraps up our presentation of the Southeast Memphis 2 portfolio. If you have any questions as it relates to this presentation, the information provided, you can reach out to myself. My contact information is there, as well as Philippe, and we will get you answers to your question. And we thank you all for who joined me live, and thank you all who are watching this recording. We appreciate your time, and we look forward to moving forward with you with our Southeast Memphis 2 portfolio. So thank you, Patrick. Thank you, Philippe. Thank you, Mark, who was unable to join due to previous commitment. So thank you, everyone, again, for taking the time to learn about our project, and looking forward to hearing from you shortly. Thank you, everyone.